All right, today we're going to decode the language of commercial real estate finance. You know, the blueprint that literally turns empty lots into massive city skylines. Let's dive right in. So, how does that even happen? I mean, you drive by an empty lot one day, and then poof, a few years later, there's a 50-story building there. It feels like magic, right? But it's not. The answer is all about a really carefully constructed journey of capital.
And it all starts with a loan, but probably not the kind of loan you're thinking of. See, we all kind of get how a home mortgage works, but financing a skyscraper or a huge shopping mall, that is a whole different ballgame. A completely different universe, really.
Okay, so here's the absolute biggest difference you need to grasp. A home loan? That's all about you. It's about your salary, your credit score. The bank is basically asking, can you pay this back? But a commercial loan, that's all about the property itself. The bank's big question is totally different. Can this building generate enough cash to pay its own bills? See the shift? The whole deal lives or dies on the asset's ability to make money. All right, so let's start this journey right at the beginning. Part 1, from blueprint to building. We've got our plans, we've got an empty patch of dirt, and, let's be honest, a ton of risk. This is the construction phase. Now, a bank is not just going to write a multi-million-dollar check and say, good luck. No way. A construction loan is given out in pieces. They're called draws. So as the developer hits these major milestones, the foundation gets poured, the frame goes up, the roof is on, the lender sends someone out to inspect the work. If it checks out, they release the next chunk of cash. It's all about managing their risk, step by step by step. And you know what else? The lender won't pay for the whole thing. Not even close. They use a metric called loan to cost, or LTC. So let's say a project costs $10 million. A lender might only put up, say, $7 million, which is 70% LTC. That means the developer has to bring the other $3 million to the table in cash, in equity. They have to have some serious skin in the game. So, you got to remember, this is by far the riskiest point in a property's life, and the financing totally reflects that. Construction loans have the highest interest rates of any loan type we'll talk about today. They're short-term, usually just 18 to 36 months, and they're often interest-only, which makes sense, right? There's no rental income coming in yet to pay down the actual loan balance. Okay, let's fast forward. The crane is gone, the windows are sparkling, but the building is basically a ghost town. It's built, but it's not stable yet. This is where you need to bridge a pretty scary financial gap. So, the building's up, but the tenants are not in. What now? This is such a critical moment. That really expensive construction loan is coming due, but the property isn't making enough money yet to get a good, stable, long-term loan. You're stuck. So how do you get from A to B? From a risky, empty building to a safe, cash-flowing machine? Well, you use a bridge loan. The name says it all, right? It's short-term financing, usually 1 to 3 years, and its whole purpose is to bridge the property from that risky, transitional state to a stabilized one. It gives the owner time to lease up the space, maybe do some final touches, and just get that rental income flowing. Now, these loans are kind of in the middle, price-wise. They're more expensive than the permanent financing we're about to get to, but they're cheaper than that construction debt. A lot of times they have floating interest rates that are tied to a benchmark, something called SOFR, which is just a key market interest rate. The main thing is they give the owner that crucial breathing room to get the job done and stabilize the property. And that brings us to part 3, the long-term play. This is the goal. This is what most investors are aiming for. The building is full, those rent checks are hitting the bank account every month, and the property is now a stable, predictable, beautiful asset. This is where you get the holy grail, a permanent loan. We're talking long-term financing, maybe 5, 7, or even 10+ years. And it comes with the lowest interest rates. Why? Because the property has proven itself. It's generating consistent cash flow. For the lender, most of the risk is gone, and what's left is just a safe, steady return. So, how does a lender know a property is safe? How do they decide? They obsess over one key metric, the debt service coverage ratio. We call it DSCR for short. It's a really simple but incredibly powerful formula that answers the single most important question: does this property make enough money to comfortably pay its mortgage every single month? Let me show you how it works. Let's say a property brings in $125,000 in net income for the year, and its total mortgage payments for that year are $100,000. You just divide the income by the debt. That gives you a DSCR of 1.25x. That extra 0.25 is everything. It's a 25% cash flow cushion. It means that after you pay the bank, you still have 25% of the mortgage payment left over. And most lenders, they want to see a DSCR of at least 1.20x maybe 1.30x, before they'll even think about giving you their best loan. And for multifamily properties, apartment buildings, the absolute A-tier financing often comes from what we call agency debt. That's Fannie Mae and Freddie Mac. They offer incredibly low rates, really long terms, high leverage, and a super important feature: the loans are usually non-recourse. So let's talk about what that actually means.
Okay, so we've followed our building from a dirt lot all the way to a stable asset. Now let's switch gears for a second and talk about the fine print. These are a few must-know terms that apply across the board no matter what kind of loan you're looking at.
And this is a huge one: recourse versus non-recourse. With a recourse loan, if things go wrong, you default, and the property sells for less than you owe, the bank can come after your personal assets. We're talking your house, your car, your savings account. It's all on the table. But with a non-recourse loan, the bank's only option is to take back the property. The building itself is the only collateral. That's it. Huge difference.
Okay, but what if the main loan isn't enough? This happens all the time. Let's say the senior lender, the main bank, will only give you 70% of the money you need. You've got your own equity, sure, but what if there's still a gap in the middle? Where does that money come from?
Well, you can fill that gap with something called mezzanine debt. Think of it like a capital sandwich or a stack. At the bottom, you have the senior loan. That's the safest and has the lowest interest rate. At the very top, you have the owner's equity. That's the riskiest money, but it gets the highest potential return. Mezzanine debt is the layer that gets sandwiched right in between. It's riskier than the senior loan, so it has a higher interest rate, but it's a super useful tool that lets a deal get done without the developer having to find a ton more cash.
And last thing on the fine print, a really important word of warning. Unlike your home mortgage, you can't just decide to pay off a commercial loan early. If you try to pay off a fixed-rate loan ahead of schedule, you can get hit with absolutely brutal prepayment penalties. And I'm not talking a small fee. We're talking penalties that can easily run into the hundreds of thousands or even millions of dollars. It's a huge deal.
Okay, let's pull this all together now. We've looked at all these different loan types and terms, and when you step back, one really clear central idea starts to emerge. And this is the main takeaway, the thing you absolutely have to remember. Commercial real estate financing is not one size fits all. It's a toolbox, and you have to match the right tool to the right job. Your business plan dictates the financing. If your plan is to build from the ground up, you need a construction loan, and your key metric is loan to cost. If your plan is to buy a building and fix it up, you need a bridge loan. And if your plan is to just hold a stabilized property for long-term cash flow, you get a permanent loan, and the lender is going to be obsessed with your DSCR. The plan comes first, then the financing.
So when your business plan is set, the real question becomes, what financial architecture will you build? Because that's what this is. The financing is the architecture of the deal. It isn't just about getting the money. It's about getting the right kind of money that perfectly fits your strategy. The financial structure you build is the foundation for everything that comes next.